I get told a lot that I keep discussing the same stocks all the time. So in this video, I have two stocks that I haven't really talked about much before. One of them is a REIT. I only talked about it once on the channel, but the second one is a stock I've never talked about. I can guarantee you've never seen a YouTube video on the stock from anyone on YouTube. It's very pretty much under the radar. It's an 8% dividend monthly payer. They pay out the dividend every single month. It's around a $2 billion market cap, a Canadian company that most of you, I'm pretty sure you've never heard of it, unless you're part of my own investment group where I buy a lot of undervalued and underrated stocks that most people never even heard of. This is where I tend to find a lot of value. And this is a stock that I've been in and out many times. I don't currently own it, but I might get back into it in the future. So it's gonna be pretty interesting in the video. I think you guys really are gonna enjoy it. Now, the problem is that I don't know why, but my videos have not been getting the same traction I've been getting before for some reason. Also, I get a lot of likes from you guys, a lot of engagement, but it's still, I don't know what's happening with the algorithm. So it would help a lot if you could maybe please press the like button if you enjoyed this video, and maybe leave a nice comment or a bad comment or whatever you want. Just give me any feedback in the comments. That would help me very much. Now, the first stock, which is a REIT that I talked about once, some of you might be familiar with the stock, and this is a company called ADC, which is Agree Realty. A lot of you know that I've been getting a little bit bullish on REITs. This is another one. It's sitting at the same level it was sitting at in 2018, something like September or October of 2018. I'm not going to spend much time on it, so I can focus a little bit more on the second stock. But Agree Realty, I love their tenant profile. Their largest tenant profile is Walmart, 6.2%, pretty amazing. Tractor Supply, it's not the best, but it's not bad, 4.9%. Dollar General, which I'm not a big fan of, 4.8%. They have other ones, CVS, Dollar General, Kroger, O'Reilly's, Lowe's, Home Depot, BJ's, something like AutoZone. And this is what I like a little bit more between Agree Realty and Realty Income, is that they have more exposure to better kind of tenants, something like O'Reilly's and AutoZone, which I personally believe that Realty Income doesn't have exposure to. And their largest tenant is Walmart. The largest tenant for O is, I believe, something like Walgreens or Dollar General. So that's pretty amazing in terms of Agree Realty. I love the management in this company. They are pretty amazing. Now, one of my favorite things about it is the fortress balance sheet. It is really a fortress balance sheet. They have no debt due before 2028. So you don't have to worry too much about short-term maturities or about fluctuating interest rates, if they're going to be able to refinance or not. There's nothing going to be due until 7 years from now. And I'm pretty sure that 7 years from now, we're likely going to have lower interest rates than we have right now. I'm pretty sure of that. It's not 100%, but that's what I would bet on, which means that as the debt is not a big problem, it's not such a big concern with something like Agree Realty, while you have Realty Income, which is maturing, I believe, in 2026 and some of it in 2025. But in terms of the balance sheet of ADC, it's pretty amazing. I love the discipline of the management. It's great. They do have the monthly dividends. They pay it out every single month. They grow it around a 6%, 10-year CAGR, around 6% on average every single year. It's around a 76% payout ratio in terms of adjusted funds from operations. So it's pretty well covered, and they have a little bit more cash to do acquisitions or pay down debt or to do whatever they feel like doing. Now the dividend is around 5.07%, so around 5%, which is not the highest dividend in the world. And it's now sitting, as high as it's ever been in the last 5 years, pretty much. If you zoom out on all, it yielded around 20% in March 2020, in 2009, which I don't believe we're going to get there. But now the dividend is around 5%. It's not bad at all. You could buy short-term treasuries and hold it, and then you could get the 5 or 5.5% risk-free. I get it. But something like Agree Realty is growing FFO per share 4 to 6% every single year. So you're getting this dividend that's 5%, but the dividend is growing. The company is growing on a per-share basis, and you also get potential price appreciation whenever the multiple gets back to the mean. Now it's sitting lower than it said in March 2020, around 14.4 times. The mean, which is pretty close to Realty Income's mean, is around 17.5, and it traded as high as 25 times. Now it's sitting at 14 times. So you're getting a 5% dividend that's going to grow around 6% on average. You have the company that's growing on per share, FFO per share, around 4 to 6%. You have the 5% dividend. This is something like 11% every single year. And you get potential price appreciation whenever the multiple reverts to the mean, whenever we potentially have lower interest rates in the future. For me personally, I would much rather bet on something like Agree Realty with such balance sheet than just buy short-term treasuries. But this is not how most people are saying. But I see a lot more upside with REITs than I see buying short-term treasuries. So I really like Agree Realty here. I love the management. Again, the balance sheet is pretty amazing. The tenant profile is not bad. Amazing balance sheet. So I'm a fan of this company. I don't own it yet. It's on my watch list. I might buy it a little bit in the future if it goes back down like maybe $50, $51. To me, that would be like too cheap to ignore. But I do have different REITs in my portfolio. A lot of apartment REITs. Some of them are retail. I almost bought an office REIT, but I missed out on it. I might share it in some other video if it gets back to fair value. But I'm bullish on REITs in general. Now, this is the second stock that none of you have ever heard of it. It's an undervalued company with over 98% gross margins. 98%. I mean, there's no tech companies in the world with 98% gross margins. Unless you know it, you could let me know in the comments. But I've never heard of that before. And this company is called FRHLF, which is Freehold Royalties. This is a Canadian royalty company. I'm going to explain the business model soon. Some of you are familiar with the business model. But if you know TPL, which is Texas-Pacific Lands, this is a royalty oil stock that I used to own before. I talked about it. I made 40%. I got out, never got back in. But I've been getting in and out of FRHLF, which is Freehold Royalties. It's kind of like whatever TPL was, but with better management, and it's much, much cheaper than TPL. So the stock has been consolidating for months. It's pretty tradable if you'd like to trade it, but the dividend is around 8% paid out every single month. Now it's at $10.81 per share. Now the royalty model is pretty amazing. They make over 65% of the production from Canada and around 35% from the United States. Their cost per barrel is something I believe like $18 or $20, something like very low, because a royalty company does not put up the CapEx. You have companies like ExxonMobil, Royal Dutch Shell, Chevron, Occidental. They put up all the CapEx to drill on TPL's land or on something like Freehold's land. And because they are drilling on Freehold's land, they give Freehold royalties. And Freehold does not have to put the CapEx. ExxonMobil takes care of all the inflationary costs, so it's a very safe business model, which is why if you look at the gross margins, it's something like 98 and 97%. Net income margin is something like 60 or 62%. It's higher than Visa. This is the kind of business model this is. It's pretty bulletproof in my opinion, and it's not too sensible to inflationary cost, and it's much safer if you're a very long-term investor in oil. I tend to prefer to invest in royalties instead of the producers, because the royalties, they don't have as much exposure to higher inflation and just fluctuations a lot in commodity prices as much as the producers have, which is why I'm a big fan of royalty companies, especially Freehold Royalty. We talked about the dividend is around 7.7%, and this is the big trick, that this dividend is covered till pretty much around $50 per barrel. So as long as oil is above $50 per barrel, this dividend is covered. The current payout ratio is something like 71%. So they pay out around 71% in terms of a dividend, and the next 30% they use it to do acquisitions. This is how they expanded in the United States. They acquired royalty assets for dirt cheap in the United States. Some of them were in March 2020, some of them were in 2022. So they use around 30% of the FFO to do acquisitions, and 70% is a dividend. And they can sustain the dividend as long as oil is above $50 per barrel. And if you look at history, most of the time, oil has been above $50 per barrel, especially after March 2020. We have much higher inflation. Oil should already be much higher than it is, yet it's sitting at $77. So as long as oil is above $50 per share, which most of the times it tends to stay above $50, and if it ever goes below $50, it doesn't stay below $50 for a very long time. Especially if you look after the 2005, it rarely went below 50, and if it ever got below 50, it didn't stay there for like 5 or 6 years. It didn't stay there too long, something like 6 months to a year on the maximum, sometimes just a few months. So as long as it's above 50, the dividend is not going to be cut. If it ever goes below 50, then either Freehold might have to use some debt to sustain the dividend, or they might have to cut the dividend. And a lot of you are going to say you should wait for a dividend cut. Well, yeah, maybe it's true, but maybe we never see oil below $50 again. I mean, maybe we never see that. We have much higher inflation. Oil should already be much, much higher. So I believe this is a safe bet at $50. Unless they do more acquisitions, they increase production, then it could go to something like 40 or 45 in terms of them to be able to sustain it. But without any acquisitions, it's $50 per barrel for a dividend that's close to 8%. The balance sheet is not bad at all. They have something like 152 million of long-term debt. This is not bad at all, because if you look at their income for guidance, they have between 250 to 200 million of FFO. The entire debt is around 150 million Canadian, which is really not bad at all. And these assumptions are based on $80 per barrel on average. So if it's on average around $80 per barrel, from pretty much for 2023, this is how much they expect to bring, between $250 million to $280 million. But taking the $250 million cash from operation, the current market cap is something like 2.2 billion Canadian. So the company is trading something pretty close to 8.5 times FFO per share. And they don't have any capex. They don't have any cost. No inflationary costs, no capex to drill the oil and all these kind of things. It's an amazing business model. 97% gross margins. Something like TPL. TPL trades around 35 to 40 times FFO, funds from operations. Something like Freehold is trading at 8.5 times. Although it's much smaller, so this is one of the reasons why, and TPL is better positioned in general. But I love Freehold. I mean, it's dirt cheap at 8.5 times FFO, fund from operation. I'm not sure for how long this is going to remain like that, but trading at 8.5 times and paying an 8% dividend, that's pretty sustained until $50 per barrel with a balance sheet that's pretty good. It's not bad at all. And they do have some kind of an acquisition strategy. This is how they were able to expand in the United States. So I'm getting acquisitions which could grow FFO. I'm getting a pretty well-covered dividend. And I'm getting the company at only 8.5 times funds from operations, which is dirt cheap. And I believe this company is extremely undervalued. It's risky, so maybe the whole thesis is wrong if oil goes below $50 per barrel and we have a dividend cut if it stays there for a year or two. So I could be wrong on this thesis, but as long as oil is above 50, the company is extremely undervalued. It doesn't mean it can't go lower, but it's pretty safe in general. I much rather buy Freehold than ExxonMobil or Chevron. This is just the way I do it. I always love royalty companies, and I think Freehold is an undervalued dividend stock that most people never heard of in Canada. But this was my honest opinion on Freehold and on ADC. These are my two picks for dividend stocks now for November of 2023. I hope you enjoyed this video. It was not financial advice. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.